Hey, John, how are you?
Good, good. Yeah, I'm glad you came on, man. I'm glad you came on because I think we connected a couple days ago,
Hmm.
and I think it was like over Telegram. It was just like a polyfactual, polyoptions type of networking thing.
Yeah.
But I like as we were talking and as you were getting into your product, I was like, these guys are doing some really innovative stuff. So I wanted to get you on the live stream just because I have not heard of kind of building options on prediction markets yet. This is a first for me in terms of hearing about that, and it makes so much sense too. So I
Sure.
just wanted to have you on so that you could talk a little bit about yourself, your team, and what you guys are building. And yeah, let's I guess my first question for you is just maybe a little intro about who you are, what you're building,
Mhm.
and kind of what you're working on.
Sure. Yeah. Thanks for that background too, for having me on. Really appreciate the opportunity to talk to your audience, and hopefully to have them talk back to us. So some folks may know me from ACE, American Civics Exchange. Prior to that, with Predict It. So I've been kicking around in the prediction market space for a number of years now. This project, Polyoptions, which, as you said, is options on prediction market, specifically on Polymarket, and we can get into what that actually means and how that actually works in a minute. But it's something that we've actually been sort of thinking about and waiting to pounce on for years, but probably a decade, for the time to be ripe. It's a derivatives layer that goes on top of, again, in this case, Polymarket, the same way that options on equities or options on traditional futures contracts have been a robust part of those asset classes for years and decades and centuries. And as you were alluding to, it's something that we just think makes sense, and it's something that the industry, the prediction market industry, the so-called underlyings, the underlying assets in this case, for our derivative products, have not really been robust enough yet. Haven't been liquid enough. Haven't had a sophisticated enough trader base yet. That's not a knock on these products or on the sophistication of the traders. It's just that to layer options on top of an asset class, it really needs to be very liquid, very high volume, and have a really large and technically sophisticated, financially sophisticated, broad user base. And of course, as probably everyone watching now realizes, that is the sort of asymptotic inflection point that we've hit as an industry that we've all collectively seen unfold in the last year or two, but in the last couple of months, incredibly so. And just hours ago, with the official launch of the Polymarket US app, this is not slowing down, not showing any signs of slowing down going into 2026 either. So that's why not only has this made sense to us for a long time as a natural product expansion and extension of prediction markets, but why we really think this is the right time. So given that our team background is really one that, folks who are sort of perpetually animated by financial product innovation and engineering, particularly within the world of prediction markets, we're really excited that we're at this moment now, that we're in the, officially in the Polymarket Builders program, so that we have some, sort of bit of a platform upon which to roll this out. We're sort of undertaking three broad initiatives at the same time. Right, one is on the technical development and the engineering, testing, and auditing of the smart contracts that actually controls the logic of these products. Two is in lining up liquidity, both among big tier one institutions, but also virtually everyone, including anyone watching that would like to trade on us. They can be liquidity providers and reap rewards from it. But that's obviously a critical part to our success. And then three is just general engagement and education of the prospective users, and that's what this forum is ideal for, is sort of introducing the product to people, showing people what it can actually be used for. That it's not just sort of a clever vehicle to bet on something in a different way, but actually serves an important purpose in any truly robust, full-fledged asset class, which again, prediction markets now are truly becoming. So yeah, eager to go in any direction you want to take it, but I think that's probably, I would guess, most useful, or something that is at least partly useful to viewers, would just be getting an understanding of what the products are, right? How they work. I don't want to go over stuff that might be overly obvious, but it's my guess just from conversations we've had that a lot of folks who are pretty sophisticated on prediction markets have heard of and maybe have a basic understanding in the abstract of how options work, but don't maybe understand all the nuts and bolts.
Yeah, no, I mean, thanks for that description. I think that's, I think like I have so many questions about, and we got on a little bit about it in our private call,
right?
Where we got into a little bit about how it technically works, and we can kind of revisit that here because it is a little bit different than normal options. You know, even though it's still cloud kind of based systems all around, you know, there are a few subtle differences. Which could be cool to get into. But I kind of, you know, I had no idea that you worked for Predicted. That's really interesting. So you've been in the prediction market space for a lot longer than I initially thought you were.
Yeah, quite a while. I worked with Predicted doing market curation primarily, also some business development, but mainly market curation from their launch in 2014 through about their first 5 years through the end of 2019. Still in touch with the team there. They're great folks at Aristotle. And Predicted, but yeah, that was it's where I learned a lot of hard lessons about how you write good rules and what makes for robust markets. And but yeah, one capacity or another, been kicking around the broader prediction market world for a number of years. I'll just say too is before we delve into more nitty gritty specifics on the products, if folks want to go look and sort of tinker with this kind of stuff, we're just at polyoptions.com or on X at polyoptions. People can also email me, flip@polyoptions.com. So if you have specific questions, but if as we're talking, people want to pull up a second screen and just go kick it around, it's just at polyoptions.com. But leave it on to source deal. Like what do you think would be useful information to talk about how these things work?
I think I'd like to get, so I think a little bit at the end of it, I think we could get into a little bit about the platform. I'd actually like to say, if you're open to it, I'd like, if you're open to kind of pulling it up. But the one question I wanted to ask you before we do that though is, so just kind of like some general questions about prediction markets. So you've been in the prediction space for a long time. You worked with Predicted. I'm curious, when you were working for Predicted, did you anticipate prediction markets becoming as big as they are right now? Was this kind of a surprise, or did you always think they would kind of be neat?
No, absolutely. It was our founding philosophy of our firm was that, and that goes back even further. That actually goes back to 2007. So we've been around for quite a long time. But no, our thesis back then was simple that, policy risk, political outcomes, represent the largest otherwise unhedgeable category of risk, that every other category of external risk, whether foreign exchange rates or interest rates or soybean prices or gold prices or oil prices, is fully hedgeable on a robust futures market. And why aren't politics and public policy not? So that's been what we've been trying to push towards, going on 2 decades, just based on that sort of first principles analysis that futures markets are huge, risk markets are huge. Any mechanism that enables you to more efficiently reallocate risk is a market that is screaming to exist, and nowhere has it been screaming from an economic need more loudly than for event markets, and specifically political event markets. It's just that you've had this huge, deep, old regulatory and legal moat that has kept it from fully coming to fruition. I mean, Predicted was sort of the first one to do it in the U.S. legally, but of course they had the very small position limit, which kept them, at least at the time, from becoming what now a Polymarket or a Kalshi is. But that was sort of the big first crack in the dam, I think, was what Predicted managed to do in 2014 with their no action letter released from the CFTC. And of course now, in sort of leaps and bounds, some big, some small, but all meaningful, with several of these other participants in more recent years that have really turned that crack into the whole dam crumbling down. And obviously now we have, $9-10 billion a month in volume on these markets. So it's been incredible to see. But yeah, I'm not so humble as to say that this was a surprise. We've seen this coming and known this is inevitable, and it really is just the beginning. If we're doing industry-wide 10-ish billion a month, I think that's 10x in a year, and that could be 100x by 2028, by the next presidential cycle.
Yeah, I was explaining to so I have a family member that works in like traditional finance, for one of the large kind of firms
Mhm.
out in New York, and that I was explaining, and he was like, well, there's so many ways to hedge, right? Like I understand the value of buying like no on the Fed rate cut or yes on the Fed rate cut if you're trying to hedge.
Right.
There's other ways to hedge that in the stock market.
Yep.
My point to him was that, like, contextually, that might be true, but how accessible is that
Hmm.
to like everyday people, right? Like,
Right.
contextually, it's hard for them to think about things like that.
Yeah.
Like, oh yeah, I buy this bond or whatever to hedge my. Like, it's much easier to say like yes or no on the Fed cut.
Hmm.
I'm just curious, like, kind of tying back into what you were saying earlier to your point, like, how big do you think these markets are going to get in the near term? Do you think that they are going to be like, and ask someone building options, like, where do you see, how big do you think the options market will be? It's a long question,
Yeah.
but how big do you think the options market will be for, these types of markets, basically?
Yeah. So to the first question, I mean, I think again, event markets as risk markets will become one of the largest, if not the largest category of commodity futures. What will become seen as just another traditional silo of commodity futures markets, and these are, depending on how you count them, multi-trillion or even quadrillion-dollar markets. Now that's misleading in the peculiar economics of commodity futures, where you normally have, the market value of, say, an oil futures contract might be a few $100s, but the underlying oil that you're trading on might be hundreds of thousands of dollars. So that's sort of the big, bottom of the iceberg number that gets grossed up into these huge, just meaninglessly huge numbers that represent the actual volume. But there's still, multi-hundred billion dollar or even multi-trillion dollar markets in terms of the actual market value being traded. And again, just from a natural hedging and public interest perspective, I think event markets will be as large as or larger than any of the others. So I think this literally is something that winds up with a 13 digit figure in terms of the actual volume, annual volumes we're going to see. In terms of how big the options layer can be on top of it, I mean, you can look at like the largest existing category of options on futures, as distinct from options on equities or other assets. But options on futures specifically is options on interest rate futures. And in that case, the market value of the options layer is about 50% as large as the underlyings themselves. So the volume is nearly half as big on the option side as it is on the underlying side. That's a little bit different, or it's a lot different, but it's meaningfully different in prediction markets than on traditional futures for a couple reasons. One is that the benefits that options throw off in terms of more specific risk management, being able to exact better leverage, to limit your downside, to make much more specific or nuanced bets, is much less. That benefit is much less on short duration, short expiring markets. So we're not expecting, certainly not at launch and possibly ever, to be trading or at least doing meaningful volume on underlying prediction markets that are expiring tomorrow, right? Or the price of Bitcoin next hour, right? Or a basketball game that takes place, this Friday. In part, like I said, because the short expiration makes the pricing go wonky and it throws off less leverage, and convexity is sort of an options specific word, but it's what sort of delivers the options magic. Loses some of that magic on the very short duration. But obviously, there's no shortage of much longer duration markets. They're either a month, multiple months, or in the case of elections, multiple years. And of course, those oftentimes turn into be the most high volume markets. So in terms of like as I mentioned, the interest rate futures example where the options are roughly half as large as the underlying. With prediction markets, let's say half is also a plausible multiple. It would only be half of whatever you might determine would be the sort of the subset of options suitable prediction markets, right? So somewhat longer term ones, ones where the underlying platform like Polymarket doesn't already have multiple strikes and expiration dates. Because if you have multiple strikes and expiration dates, say like on a crypto market, you can sort of synthesize an option strategy just by buying and selling different, different components. Is basically setting up either vertical or calendar spreads by buying one tranche and selling the other. There's actually, it was registered just a few days after us. There's another startup out there called Polyoptions with a Z that they have a different approach. I think they're basically a terminal for trading Polymarket, but focusing specifically on those, like on the ones where Polymarket does have multiple strikes and expiries, so that you can sort of synthesize a crypto option rather than trading in the crypto options markets just by buying and selling multiple underlying Polymarket contracts. So very much not our focus, but it's interesting that they have a very similar name. So let's throw out a number. Let's say a quarter of Polymarket contracts are option suitable, and the multiplier is roughly 1/2 of suitable volume that would be reflected in the options layer. Then you might have something like 10 to 15% of the volume that you'd see on the underlying on Poly as you would see on the options market. But that's sort of a thumb in the wind, but I think it's at least a somewhat informed thumb in the wind.
Yeah, it's interesting because the way you're describing it almost sounds like it can't apply to all markets equally, right? There's
Right.
certain markets that just don't fit within the options paradigm.
Yep.
And but it would be especially useful for longer term markets, which I actually think is a need, because I think that the short term markets, like a lot of people, like mention markets, for instance, people just jump into that to make a quick buck. But I think for those long term markets, you actually need perhaps more hedging mechanisms for people to actually jump into those
Yeah.
confidently.
100%. Yeah, that's not only where they work better, but I think that's where you're going to find the real felt need, that as soon as this exists and people say, oh, okay, I see what I can do with this. Yes, I need that and I want that. Maybe is this a good sort of juncture to define a couple terms, just so that when we talk about specific strategies, we'll know that everyone's sort of on the same page?
Yeah, go ahead. Yeah.
Okay, so then apologies to anyone for whom this is rudimentary, but we're going to talk about things like calls and puts, words you may have heard, but they're pretty simple. Call is basically just an option or the right to buy something, anything, at a specific, pre-specified price at some point in the future, up to some maximum, future date. So this could be, again, the right to buy a barrel of oil for $80 at some point before the end of 2026. So if oil goes to $100, well, hey, great, you can buy it for 80 and because you have the option to buy it for 80 and then sell it on the public market at 100, and you've made $20. And maybe that option only costs you $5, so you've quadrupled your money. Versus if you had just bought the underlying, if you just bought the barrel of oil at 80 and sold it at 100, you only would have made 20%. So 300% instead of 20% is obviously immense leverage. The downside is if oil went below 80, then expires worthless, right? Because you're not going to buy it at 80 because it's worth less than it now. So you're not going to exercise. That's called expiring out of the money, when there's no value to it upon expiration. It's in the money, there is value to it. If it's at the money, it's basically precisely worthless. And a put, similarly, is just a right to sell, the option to sell something at a pre-specified price. So if I want to buy a put on oil at 80, means I think it's going to go down. And if it goes down to, say, 70, well, great, I can buy it at 70, and now I have this contract where I can sell it to someone else at 80, and I've made $10. That's basically all there is. Those are the two building blocks. And really, when it comes to prediction markets, it's one building block, right? Because a call on yes is identical to a put on no, right? Because buying yes is the same as selling no. So if I have the right to buy yes is the same as the right to buy no. So a call on yes is a put on no. So really we have one building block. It's the call option. It's just the right to buy one side of the Polymarket conditional token at a pre-specified price at some point in the future, up to some maximum date, which we call our expiration date, not to be confused with the Polymarket end date, which is later than our expiration dates. And so the strategies that you can layer and construct with that single new primitive get more and more complicated. And as you see, the different payoff diagrams become more and more convoluted. But there are sort of a small handful of typical ones that are used frequently on options markets, on equities and futures, that achieve sort of these common risk management or leverage or time-specific investment thesis goals. And that's sort of what's interesting, I think, to delve into. But it's having that sort of basic foundational understanding of what these contracts are is important before moving on to that. And a little bit, just really quickly, structurally, how this would work in practice is, so we have a separate club, a separate order book from Polymarket, where you connect your wallet, and you can actually do that right now if you want to. At polyoptions.com, you can connect your Polymarket wallet. You can see all of your live holdings come through. It's read only. We can't do anything with it yet, other than sort of show you, let you build and price and see visually what would happen to your positions if you were to put on one of these option strategies. But once these smart contracts are audited and launched, we'll then see them on our order book for each given Polymarket that we're trading an options chain on. You'll see a bunch of tradable stuff. So say it's one outcome on one multi-outcome market, like will Gavin Newsom win the Democratic nomination 2028, and say that's currently trading at like 30 cents, something like that. Let's say 30 cents for that one outcome on that one market. On our order book, you would see, okay, Newsom call option with a strike price of 30, that's at the money, right, where it's currently trading, expiring end of 2025, 12/31/25. But you'd also see that same strike expiring on 1/31/26 or on 3/31/26, and maybe every month or every quarter from now through mid 2028, whenever the convention is. You also, though, it would be like a grid. So on one dimension you'd see the different expiration dates, on the other dimension you'd see the different strike prices. So you might not want to buy a call on Newsom at 35. You might want to buy a really deep out of the money call, right? One that has basically no intrinsic value until it goes up quite a lot. So maybe with a strike price of 50, right? So you think down the road he's really going to pop. No one else is going to catch fire. AOC is going to primary Schumer, and she's not going to be a factor, and Newsom's going to consolidate support. You can probably get that very out of the money call very cheap right now, maybe just for a penny, right? If he does go up to 60, well, now you've made 10 to 1, right? Because it's 10 above 50, and if it costs you 1, that's a 900% increase, but only if he goes way up, right? So this is an example of you can kind of dial in your specific thesis, and then so that's with what we call the plain vanilla calls and puts, right? I want to pick an event on Polymarket where I may or may not have an existing Polymarket position, but I want to use these vanilla calls or puts to sort of to say, here's where I think this price is going to be at some point in the future before the expected end date on Polymarket. So it's sort of more nuanced bet, both in terms of where you think the price is going to go, because you might not want to buy all the upside, right? You buy AOC at 12, you're paying for the whole possibility that she goes all 100. But if you just want to eke out the next 3 cents to get her from 12 to say 15, you can do that much more efficiently by you buy a call at 12 and you sell a call with a strike of 15. So you're only going to profit up to those next 3 cents of upside. But because you sold the call, you actually collected premium on that. So if the 12-cent calls cost you 3 cents, but the 15 strike calls that you sold were worth 2 cents, then your net
Mhm.
cost, per, what we call this a vertical bull call spread, is only 1 penny. And so if she does go up to 15,
Yeah.
then you've made, again, 200% because it cost you a penny and gave you back 2. Versus if you just bought at 12 and sold at 15, obviously you've made 25%. So it's an example of you not only have opportunity for leverage, but for very potentially cost efficient, capital efficient leverage. Because you, again, can dial in, well, I don't want all that upside. I just want to pay for the next 10 cents. Or I don't even want the next 10 cents. She's at 12. I want only the range between 25 and 30, right? Then
Yeah.
you get a great bargain on that. And if this very specific thesis of yours doesn't happen, then again, it might expire worthless. But it's also not just to be speculative. And I won't go through too many of these, but another one that you can play with on the site, and this is if you do have an existing position in the underlying poly market. Say you have a huge position in, I don't know, something to do with the Ukraine war, right? And you're sure it's going to pan out. It's trading at 90 cents on the dollar, doesn't expire for a year. You've got $100,000 locked up in it. It's not liquid enough that you can sell it without tanking the price. So you think it's still fairly priced and maybe even cheap at 90. So you're inclined to hold it, but you don't want to tie your money. You have other things you want to put your money towards.
Right.
You can go and sell a call, we call a covered call because you own the underlying on the options layer. And ordinarily, if you were just selling a call without owning the underlying, you have to fully collateralize your max loss on that call, right? Because when you're buying an option, it just costs you a premium. You don't have to exercise it, so you know your max loss was the cost of the premium. If you're selling it, writing a call, you're on the hook now to let the buyer, the holder, buy this thing from you that might be worth much more now. So you're in typical options trading, your downside can be infinite. But happily, because prediction markets are bounded between 0 and 1 or 0 and 100, your downside is always finite, right? But if someone buys a call from you at 40, your max downside is going to be 60, right? Because they might buy something worth 100 from you at 40 and you're instantly out 60 cents on the dollar. So if you're writing that call nakedly, you have to put up 60 cents for each contract that you write. But if you hold the underlying, right? So something's trading at 40 and you hold it, you already own it on Polymarket, which means if it goes to 100, you've made 60 cents. So if you write a call against it on the options layer and your wallet is connected, so we can, lock or escrow that underlying share, you don't have to pay anything because you have no net max loss. Because for every penny that your exposure on the short call goes up, the value of your underlying goes up equally and offsets it. And this is why we can allow you to sell, what's called a covered call. So something's at 90, like we were saying, you got to hold it for a year. You don't really want to. You want to partly cash it out. You can sell a call at a higher strike, right? Sell a call at 95, and the premium on that, say, is 3 cents, whatever it might be on the dollar. You can simply have that now at no risk because if the call goes up, if the underlying goes up, your collateral exactly matches it. So it's a way to literally take cash off the table without ever hitting the Polymarket order book, without impacting the price, and without incurring any risk. Everything is still beautifully, fully collateralized.
Yeah, I think it's a great idea. I mean, so I was wondering if maybe we can jump into the platform too, so people can get a little bit of a visual if you're cool with that. We had one question from Aaron. I'll just show it on the screen, and I don't know specifically what it was in reference to, but basically he wants to know who's taking the other side of the trade when it comes to I think it's when it comes to writing these options.
Yeah. It's another trader, right? So we're never a participant in any of the trades. It's fully non-custodial. It's all, just like most existing prediction market platforms. There's another trader on the other side, whether it's someone who already held the long option and is reselling it to you, or whether it's someone who is writing it, so to speak. In which case, again, they're collateralizing the potential loss, the max potential loss associated with that writing, with some combination of USDC, the underlying Polymarket shares, and or other options, right? Because again, if you hold something similar, if you hold a call with a certain strike price and you're trying to sell, I'll call it a higher strike price to partially fund that purchase, then between the two of them, they're going to have a lesser max loss than either would in isolation. So, it all depends on kind of what the inventory of the person writing or selling to you is. But short answer to the question is it's just another trader on the other side.
Cool. All right. So
Do you want to pop up the platform here?
Let's do it. Let's take a look because I'm excited.
I'm going to glasses up here for a second so I can see what I'm doing. Okay. Tell me if you see that.
Yeah, let me add you to the.
Okay. There we are. So this is our homepage, polyoptions.com. There's some sort of just introductory pricing and discussion stuff here, but you can skip right to this demo platform if you're joining us there. Did that switch over? Because that changed to a new tab. Let me change what I'm sharing because that spawned a new tab, and so it's not going to be the right one anymore. Hang on a sec. And let's see if this works.
Share your screen one more time, Flip. I think.
Okay, one second. Let's see if I can do it properly. Dashboard, there we go. How about now?
Yes, there we go.
Awesome, great. Okay, so this is the main dashboard, and again, we don't have an order book live here, so you can't actually place trades, but you can kind of do everything right up until that point. And we've got a demo portfolio here over on the left, but if you wanted to connect your live Polymarket wallet, you can do that here. You can also just enter a wallet address, your own or anyone else's, if you want, to sort of see what it would be like to trade options on behalf of that trader. But for this demo account, let's just use this for the time being, and sort of most interesting to find the ones that are not pinned right at 0 to 100. But here, Graham Plattner to be the Democratic nominee for Senate in Maine. We've seen that, yeah. And so these are sort of the families of goals, right? This is all strategies: protect, limiting downside risk. This is sort of finding leverage. Income, like I talked about, the covered calls, this is a way to take money off the table without hitting the poly order book and without increasing your risk. Volatility, this is where you may not have a directional thesis, but you think things are going to move big one way or another. Maybe there's a big economic data print coming out tomorrow, and there's no good consensus on whether it's going to be hot or soft. And you don't have any idea either, but you're pretty sure that it's going to influence the Fed's, next rate decision one way or another. So you just want to bet that thing is going to, it's at 50 cents now, and you think it's going to be below 40 or above 60. There are pure volatility plays. We'll click that one, for instance, where see long straddle, long strangle. This basically means you're buying a put and a call, right? I have the option to buy this or to sell it, but maybe not for the current price. You can usually get it cheaper, and this is what we call a strangle here, long strangle, an out of the money call and an out of the money put. So for instance, Plattner, if you think something major is going to happen to his campaign, maybe there's a fundraising, deadline coming up, we're going to find out how well his campaign is doing. And he's currently trading at, 69.5. So this is automatically populated this strategy with, you see these two legs here. You got the long call on yes and the long put on yes. So, right. So the option to buy Plattner and the option to sell Plattner. So you set your two strike prices here. If he's at 69.5, this is 5 cents above the current price, or it was 74.5, now 70. It won't let me slide back to exactly halfway. And this long put is at 64.5. So basically, if he winds up within 5 cents of where he is now, both of these are going to expire worthless because it neither went above 75 and in order to go below 64.5. And that's where it needs to go for at least one of these to pay off. To pay off. And so over on where does it show the premium? Here, this is the premium of the $1,890. But of course, that is for it's based on how many shares you had over here, which is 121,000. And this is basically to hedge your entire position. So it costs nearly $2,000 for your 120,000, which is worth 84,000, but your 121,000 shares to put on this long strangle on this market. If you scroll down here too, you'll see this is the payoff analysis I alluded to a little bit earlier. It's actually more helpful if we kind of zoom into it. So the dotted line there, that's your underlying, right? That's your payoff if you just hold on to what you currently have. And this is the current price. So that's going to be what the current value of our position. And then, but again, if we zoom in here, now the red shows us where putting on this strategy would not necessarily lose money. I mean, you're still going to, the position is still going to be, worth something upon expiration. But this is, the red is sort of showing where your performance will be worse for having bought the option than if you had not bought it and simply held on to the underlying. And where it goes green is where it starts to pay off. Actually, it starts to pay off at the strikes, but you see it's still red to the right because that represents the cost of the premium. So even though you're now going in the money when you go to the right of this strike, or over here when this put goes to the left of the strike, it takes a little bit before it goes up enough that it recoups the cost of your premium. But this basically shows you the two break evens here. It's about 76 cents and about 63 cents, which of course, again, is a little bit higher than that strike and a little bit lower than that strike because of the cost of the premium. But being able to visualize it this way shows you that you'll make money if by, what is this, as the 120 days, a 4-month strangle. So if within 4 months, Graham is either above 75 or below 64, then you not only would make money, you would make more money than if you had just been holding on to the underlying. And this again shows from 0 to 100 kind of the more extreme outcomes. Obviously, if he goes to very close to 0 or 100, he will eventually, of course. But if he goes to close to 0 or 100 in the next 120 days, whereas this thing will last another 11 months, so 330 days. This is about a third of the way through the life of the underlying Polymarket contract. But if it becomes very, very clear that he's going to win or not win, you actually would stand to have a hugely outsized gain versus your underlying. Such as the case with buying a strangle. In any event, we don't have to dive into all of these, but again, they're kind of organized by theme. If you all want to sort of browse around them, and you can tinker with the settings and again see how your different payoff matrices respond. It's kind of a fun little tool to kick around. As I've alluded to also a little bit earlier, that the pricing on options is their entire business school curricula devoted to the proper pricing mechanisms for traditional options contracts. And if you've heard like the Black-Scholes or Black 76 methods, these are basically different computationally complex ways of evaluating an option based on a few inputs. Basically, the price of the underlying, the days to expiration, the strike price, of course, and the volatility, and a couple other minor things too. But the volatility of the underlying is a key thing too, right? How crazily does this number move around? So it tells you something about its likelihood of moving a certain distance in a certain number of days. That's complex enough for traditional asset classes. With prediction markets, of course, they're unique in two ways. One, it's bounded from 0 to 100, as we talked about. But two, it's got this kind of drop dead date at some point in the future. And sometimes even that is just an estimate. The drop dead date could be tomorrow, right? It's the Supreme Court do something by the end of 2026. And oops, they did it tomorrow. Now the underlying has expired. That doesn't happen, or it doesn't usually happen with stocks unless they go bankrupt, or with commodity futures. These are things that tend to be sort of more perpetual and follow well-established or reasonably well-established or observable patterns of volatility that can help you rather reliably price an option on them. But just by looking at historical volatility, you don't see what you could see just by looking at the expiration date, right? Like right now, if you pull up anything on Polymarket, in fact, most of the stuff in this sample portfolio expires in 29 or 28 days at the end of 2025. Something may have been cruising along at like 80 cents, 82 cents, very sleepily for months, right? And you look at it and say, oh, this thing is not very volatile. This thing likes to hang out at 82, or it goes between 80 and 85. And I look at this in the show, historically, I can calculate the volatility on this thing. It's very, very low. So what are the odds that in the next 30 days, it's going to move, significantly. Well, we know it's going to, right? Because that it expires in 28 days and it's going to be either 100 or 0. There's also different kind of ways to interpret volatility in an option, because the price tells you something about the uncertainty. The price is an uncertainty, right? That's what a prediction market is. So to a certain extent, the closer it gets to 50, it's sort of telling you more about the perceived volatility of the underlying event itself. So it's really kind of interesting and novel questions that it presents in terms of how properly to price these. And I'm glad at the end of the day, we're not the ones that are going to have to do it. I mean, we've sort of slapped together our best attempt at a reasonable prediction market specific, if you care, modified Black 76 options pricing model that's behind, when I click through and you see this prospective pricing, it's more plausible in the long-term ones for the reasons that we talked about at the beginning of the stream here. It's by no means perfect, and some of the big market makers that we've been talking to have been very aggressively scratching their heads with us in terms of trying to think about how to attack this somewhat novel question of how to appropriately price volatility, or how do you appropriately measure or gauge volatility on a prediction market contract to derive fair pricing on an options layer. It's I think a little bit of an open question, but it's something that people far smarter than me about this stuff are going to figure out at some point.
I know you're talking to some big guys too, which is what I kind of wanted to, I wasn't sure if you were okay with divulging that, but I know you are talking to some big guys in the liquidity space. We have one question right here, which is, how is margin going to work with short options? Will it just be max loss?
The short answer is yes, it'll just be max loss. But again, with the caveat that the max loss may not be as large as it would be if you're nakedly selling the option, right? So selling a call at 40 doesn't necessarily mean your max loss is 60, because you might have bought a call at 30, or you might own the underlying. Your max loss might be negative, right? In the case of a covered call, you're selling a call, you're writing a call, but you're literally taking home a net premium in full unfettered cash now that you get as soon as the trade is booked. So yes, it is max loss. There won't be any actual margining. And that sounds non-optimally capital efficient. But in this case, it actually delivers much more capital efficiency versus just trading in the underlying.
Okay. Well, here's a question. You don't have to answer it, but I'm curious. Are you going to be launching a token at some point?
We don't plan to.
Okay. Interesting.
That's not our roadmap right now.
But I might buy it right now if I were because I do think it's interesting. Like, I do think, like, for instance, I had an idea earlier in the year, which was, and we were actually going to do this originally for Polyfactual, which was like somehow providing insurance for catastrophic events, basically, right? Because, like, the biggest problem with prediction markets is at some point things get very predictable, right? Prediction market, like, it's a couple weeks out from the resolution. Depending on the event, things might get really predictable. And at that point, it's just good to, like, maybe jump in as a market maker if there's a lot of volume and you're just kind of hovering in the same space. But the issue is the catastrophic event thing, which for that, I could see it would make sense to write an option, right? Or to somehow hedge yourself. And that's what fascinates me about this protocol. For me, the toughest issue was just how do you go to market, right? Like, for me, it's like, it made sense. Like, okay, well, the go to market would be to target people, target traders on Polymarket, specifically market makers, maybe who basically,
right.
That was, but that was always like the biggest challenge. It's the biggest challenge with everything, right? It's like, what's go to market? For Polyfactual, we're facing that right now. It's like, and then you also have to time it to the cycle, right? Like, if the energy is bad, right? If Bitcoin is really down, I do think we're going in a little bit of a bear slump as far as the prediction market tokens go, which are kind of my barometer for testing, for looking at these things. If the energy is bad, you can't launch the product either. So so it's kind of a, it's something to keep in mind.
Yeah, for sure. It is.
Just when you're building up foundry stuff.
Yeah, I'm a little bit ambivalent about when things get cool. Things have been so scorchingly hot in this space lately, and it's great. It's I love it. It's very exciting. The energy is fantastic, um, but it also means that there's a lot of smart people trying to go after a lot of the same kind of opportunities. When things cool, sometimes that gets easier, or at least less crowded, less noisy. Gives you a little bit of space to build and iterate and ship and expand and experiment without feeling like any slight stumble and 10 competitors are going to pass you by. We're paranoid enough that that's sort of always the war footing that we're on anyway, is assuming that that's the case, and everyone's always breathing down our neck, especially when we feel like something is a natural enough fit that we can tell that it's going to exist shortly anyway. So we need to make sure that we're all sprinting all day long in order to be the ones to bring it to fruition. But as I say, no one wishes for the wintry doldrums of the cycles, but they're not without their charms.
They have their positives. Like things quiet down, and I mean, it gets tense in those bull cycles.
Mm-hmm.
It does. It gets really tense, and it's hard. It's hard to like actually think about the product you're designing.
Right.
Whereas now you can actually step back. You can think about it, which is good. So we have. So I don't want to keep you too long. I'm wondering. So we have like a question here from DeGenvol. He's just asking, will there be API access for Polyop?
There will for market makers, for liquidity partners, for anyone who wants to trade programmatically. Yes, there will. And also, I don't know if I touched on that before, as we were talking about market makers too. And so, we're talking with a number of the institutional ones. We'll also have a programmatic permissionless liquidity rewards, much like Polymarket has, modeled after Polymarket's own program. But we also have kind of a middle tier for sort of the hobbyist, the bot builder, the solo liquidity provider, the solo market maker types on Polymarket. And that there's a link to it. I'll show you right here. But right on our site, if you're interested in that, you get, if you're whitelisted into that program, you get basically just some extra goodies that the permissionless liquidity rewards program doesn't give you. Better API rate limits and Discord dev support and fee holidays. So that's just polyoptions.com/partner. Anyone who might be interested in applying for that, please do. But thank you for letting me put that plug in as well. But the answer is yes, we will have API access.
Yeah, I'm excited. I think that I like the fact that you're from Predicted. I like the fact that you have that background, and that you've been in the space for a while. I think that's interesting. Just kind of closing thoughts. What's kind of like the final, or what's the next step? What's the most immediate thing that is going to be happening with Polyoptions?
Well, there's sort of three, as I mentioned before, we're sort of on this triple track right now, right? There's the technical development. There's lining up liquidity and importantly, the sort of obligated contractual liquidity. And there's just community engagement, where we're trying to do that in spaces like this, on X, on Discord. We don't have our Discord up yet, but it's going to be soon. And if you follow us on X or sign up, connect your wallet or add your email address at polyoptions.com. You'll know when we launch that. So I think you'll just start to hear us more and more and louder talking about the products, about how they work, showing each time we ship a new little feature in the little sandbox demo platform there. We'll be touting that as something else for people to go kick around. And so it'll be incremental, but fast and furious. I mean, we've really only been doing this overtly for about exactly a month from when Poly began the builder program. Although, as I say, it's something that we've been sort of mentally incubating for a number of years. So we've hit the ground running fast, and then, again, that's in part because of this incredible moment that the industry is in right now, where it's gone from sort of ever on the precipice, right, of regulatory and legal liberalization and hitting a critical mass of volume and user base, and now it's simply busting through all those barriers every day.
Yeah.
So very exciting time. We're excited about the product and what people can genuinely do with it to really level up their trading, their investing, their hedging, their risk management in this asset class that again, I think we're largely on the same page. Probably a lot of the viewers are too, but this asset class that I think is coming to fruition and proving to be, what it's always been destined to be, which is to say one of the most important asset classes in the global financial system. And I think I said before, I think we've seen this coming for a while, but I think we're going to now see this all come to fruition on a really accelerated timeline. And it's great. I love being a part of it. And I love interacting with folks like you who are animated by all these same kind of things, and appreciate everyone joining from home. And please do reach out, come to the site. As I said, email me, flip@polyoptions.com, connect with us on X. Really eager to connect with all of you, talk to you more about what we're doing and hear from you all in terms of what you want it to do.
Yeah, same here. I'm excited to kind of keep tabs on Polyoptions, and would love to get you back on again. For later when if you when you officially kind of if you have any things coming up or anything like that, or just for like random events, it could be cool to get your insight on some stuff. Like if we have, maybe we throw you in with some traders and stuff like that.
Yeah, definitely.
Cool, man. Well, Flip, it was great having you on. And let's keep in touch.
Perfect. This was great. Thanks so much, John. Appreciate it.